Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. So Jeff published on Sunday night his weekly playbook, which is available on Substack at hugeinsights.substack.com. Jeff, welcome back.
Hey, Maddie, great to be here. Thanks for having me on the show.
So before we kick off, a little bit of housekeeping as usual. If you haven't yet, please make sure that you like and subscribe to Your Finance TV to stay on top of all of our content. But back to the main show, Jeff. Obviously, as usual, why don't we kick off with the top down?
Yeah, we've had this, rather torrid rally off of the October 27th low. I think the consensus view is that we're in a new bull market, the October low marked the low for the year. We have some doubts about that, but, we'll see, right? So far, we have seen some pretty wicked leadership from the Magnificent Seven. And this is on the back of pretty mixed earnings results. And we have one last member of that cadre to report earnings. That'll happen tonight after the close. That's NVIDIA. And I think that's it's a real potential market moving event. Expectations are extraordinarily high right now. NVIDIA posted an all-time high yesterday. And I think if there's any, shortfall whatsoever in the current quarter results or the guidance for fourth quarter or next year, then I think it could be a rather negative turning point for the market. We've been following something that is known as the cycle composite for 2023 on the S&P 500, and the market has been in pretty good harmony with that. The cycle composite is slated to bottom for the year on November 27th. That's next Monday. Now, we've also been tracking several Montgomery cycle turn dates. And it also happens to be the case that the Montgomery cycle ends on the 27th as well. And we are looking for a significant turn date. Now, the question is, will that be a low or a high? We've actually been entertaining the possibility that it might be a high, since the turn date that was slated for the 13th didn't appear to mark a high as was expected. And in fact, we think it may have come one day early, one trading day early, where the market actually put in kind of an interim low on the 10th of November and then took off again in the subsequent week. If that carries through to next Monday, the 27th, then typically this holiday week, the Thanksgiving week, tends to be an up week. Friday's a half day of trading. Thursday we have off for Thanksgiving, and it does tend to be a fairly bullish week historically. So, the surprise might be that we get a top on the 27th rather than a low, and that we trade down into year end, which is the opposite of what the cycle composite is forecasting. But honestly, cycles can invert. And so those who have studied cycles are aware of this. And it is certainly a possibility that that's the case. So, we are remaining open-minded at this point. We don't believe that, the market has put in its lows for this particular leg of the cycle. We think the decline off of the July highs into the October lows was the beginning of something, not the end of something. And so we'll see how that plays out. As a result, we continue to maintain a cautious defensive stance and have advised our clients to remain patient, minimize net equity exposure, and maximize cash reserves until further notice.
That's great, Jeff. Thank you for that rundown. So can we talk about recession for a moment, please? Where do you stand on things? Are we over one? Are we in one? Or are we going into one? Kind of like where do we kind of sit in this spectrum?
Yeah, it's a great question. I've been forecasting a recession for the better part of the last year. It has been reluctant to materialize, and we have, seen kind of rolling recessions, if you will, in various segments of the economy. We've seen it in housing. We saw it in materials. We've seen it in credit sensitives in banks, things like that. But it's kind of just bounced off. It's been kind of the Teflon recession. It doesn't seem to want to stick. And so the real question is, will the lag effect come into play in the months ahead. We've had this dramatic tightening of financial conditions, of monetary policy, and actually from our lens, financial conditions are as tight as they've been in our entire career with respect to interest rates. The real interest rate, the 1-year real interest rate, is the highest it's been since 1990. And so, whenever we get this spike up in the 1-year real interest rate and a reversal, it tends to occur as recession is materializing. Another indicator that we've been following is one created by an economist, a former Fed economist by the name of Claudia Sam, who created what's now called the Sam rule. And that's based on U3 unemployment data. And what she did is she basically created a model that monitors the 3-month moving average of the U3 unemployment rate. And when we see the 3-month moving average advance by 50 basis points off of its 12-month low, it typically is indicative of the beginning of a recession. In fact, the Federal Reserve Bank of St. Louis has begun publishing this on their website regularly. And looking back at all the recessions since 1970, this particular rule has come into play and typically marked the beginning of a recession within 3 months of its start, based on the NBA's look back and official timing of the recession. So, where do we stand right now? Well, the reading is 0.33 basis points, up from a 12-month low of minus 0.07. So it's advanced 40 basis points off of its 12-month low. In our opinion, we're starting to see a very significant slowdown in consumer spending. It's showing up in retail sales. It's showing up in retailer earnings and forecasts. For example, Best Buy just cut their forecast and guidance for the year. And the stock is down pretty significantly this morning as a result, as are a number of other retailers who have seen similar sorts of shortfalls in sales. And so, our view is that the lag effect is having an impact, and it is likely kicking off the recession in the month of November. In fact, we think when the November employment data is reported in, I believe, early December 1st, perhaps, then we will probably see that SAM rule take effect. We'll probably see the 3-month moving average, crest above the 50 basis point advance trigger signal. And that will likely indicate that we are in recession, and that we've probably been in recession for somewhere between 1 and 3 months. If my hypothesis is correct, it probably kicked off at the beginning of November.
So we're sitting slap bang in the middle of it. So, Jeff, you've looked at California as a leading indicator. Can you talk us through your thought process around this as well, please?
Yeah, California is the largest state in the United States by population and by GDP growth and by number of employed persons in the United States. And so when we start to see the unemployment data take a negative turn in California, it's usually indicative of what's happening in the broader continental United States. We've seen unemployment rise from about 4.1% a year ago to 4.8% in October. That's up 70 basis points, over a 1-year period of time. Now, if the SAM rule holds, it's very likely that increase does in fact mark a recession in California. Just to give you an example of how bad things are, in LA, the unemployment rate is 6.1%. And so, there are large segments, swaths of California where the unemployment rate is out of control. And this is based on, non-farm jobs, right? There's a lot of agriculture in California that's not included in this. So, our opinion is that, California has historically tended to lead the country at large, and it probably is doing so again. So we consider it a leading indicator.
So, Jeff, actually, that's a great point you bring up on the unemployment side. Can you drill a bit deeper on that? Looking at leading indicators, can you talk us through the jobless claims as leading the unemployment cycle as well?
Yeah, in fact, that is a fact. And jobless claims are now the highest they've been since 2021. They came in most recently at 1.865 million people that are on unemployment insurance, nationally. And there's typically about a 2 to 3 month lead time here, vis-a-vis the unemployment rate. So as we start to see these big spikes in jobless claims, the unemployment rate begins to rise precipitously over the subsequent, 2 to 3 months. And so, just based on this, it would not be surprising at all to see the national U3 unemployment rate rise above 5% in the next, 2 to 3 months.
So, Jeff, that's a great indicating point, right? So, can we now bring it back to the markets? How do we look at the unemployment rate in relation to the stock market?
Yeah, great question. And, we've looked at studies, and one that we're presenting this week looks at how stocks have basically tended to bottom about 12 to 18 months after the unemployment rate bottoms. Well, the unemployment rate bottomed nationally at 3.4% back in April. It was actually a double bottom. It first hit that level in January, hit it again in April, and we've moved off of that double bottom of 3.4% by 50 basis points so far. We're now at about 3.9%. Well, we think, if we take it back to the April timeframe, that's 6 months ago. So fast forward 12 to 18 months from there would suggest that stocks should bottom in April to October of next year, based on the history here. So, basically a big rise in unemployment tends to historically precede the decline in stocks. Stocks are only some 5-6% off their all-time highs, so we're nowhere near the lows at this point. So if unemployment is poised to move significantly higher, say up into the 5.5, maybe even 6% level nationally over the next year, if we go into recession, I think that's likely. Then stocks have a long way to fall, in our opinion, before hitting bottom sometime between April and October next year, if history's any guide.
So Jeff, I know you mentioned the cycle composite in your opening statements in regards to us following quite closely on a lot of what's being indicated by that composite. Can you kind of like talk us through where your thoughts are, what this is now indicating going forwards?
Yeah, so as I mentioned at the outset, the cycle composite has had a pretty tight correlation directionally with the S&P 500, not in terms of the magnitude of the change, but in the direction of the change, right? And so, the cycle composite was projecting a 10.5% return for the S&P this year. We got as high as nearly 20% for the cap-weighted S&P at its peaks. We came down pretty significantly from that, and it appeared that since about midsummer, every twist and turn that the market has taken has been right on, spot on within a few days of where the cycle composite would have anticipated those turns. Cycle composite's basically looking at the historical aggregation of 3 cycles. This is the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. And they're equally weighted. But as Ned Davis research suggests, trend is more important, or I should say direction of the trend is more important than the level of the trend. And so, we've been thinking that, okay, we should have gotten a high here around November 13th, and it looks like we didn't get, a high. We've moved higher since November 13th. The next expected directional move is to the downside into, the November 27th level or date, as I discussed, and that's a Montgomery cycle turn date. Now, from there, the cycle composite is expected to go higher. It's expected to close on the upside for the year. We've been thinking about cycles and how they tend to invert. And oftentimes, an expected low actually marks a high. And the market does the exact opposite of what the cycle is projecting. And so we have to remember that these inflection points can and oftentimes do invert. And so we are now open to the idea, we're entertaining the idea that the November 27th Montgomery cycle turn date might in fact mark a high. We usually look at these turn dates plus or minus 2 trading days. And if we look back to the 13th, the last Montgomery cycle turn date that was an expected high just based on the direction of the market. It may have actually come a day early. One trading day earlier was November 10th, and that marked an interim low, that resulted in, a big breakout ostensibly, from a market perspective. And so, we're kind of thinking about, based on the market's price action, we now have to entertain the idea that November 27th could mark a high, and we could be looking at a sell-off into year end, not a rally into year end. And the market oftentimes does whatever it needs to do to fool the majority of its participants. And there is a wide-ranging consensus view that we are going to get a Santa Claus rally, year-end rally that is typical from Thanksgiving to Christmas. And I think it's around 80% of the time we get a rally, on average around 2% between Thanksgiving and Christmas. And so, in order to fool the market, the S&P might do exactly the opposite. We'll have to see. I mean, we'll know in the fullness of time, as they say. But my perspective is simply that we need to be cognizant of the cycle and what it means for stocks going forward.
Well, you're not wrong. Everyone is talking about a Santa Claus rally, that's for sure. So, Jeff, let's have a look. Let's get into the nitty gritty of the technicals and such. How does the primary degree Elliott Wave analysis look?
Okay, so we rallied off of the October 2022 low in 3 waves that we are able to discern at this point. The initial rally came, from October 13th, 2022 into the December 13th high. We call that intermediate wave A. And then we saw what's known as a flat wave corrective waveform. That's a down, up, down, went to a slight new high. That bottomed in March 13th of this year, and we count that as intermediate wave B. So from the March 13th low, we can count 5 waves up. That marks intermediate wave C up, and that ends primary wave 2 of a 5-wave impulse pattern that we've counted off of the January 2022 all-time record high of 48.18. So that initial decline from January 22 into October 22, that was primary wave 1. And so the July 27th high marked primary wave 2. That means we are in the midst of primary wave 3 down. Primary wave 3 is likely to be much bigger than primary wave 1. So the decline should be of greater magnitude than the 2022 bear market decline. If we're correct, and we believe we are because we can count 5 waves down off of the July high. Now, it happened to trace out what we believe is a leading diagonal. Leading diagonal is usually the beginning of a 5-wave impulse pattern to the downside. So, this primary wave 3 itself will trace out 5 waves down. We think we're currently tracing out intermediate wave 2 of primary wave 3 down. We think we're very, very close to ending that. Like I said, perhaps it pushes to November 27th. It's also possible that it ended yesterday. We'll know in the fullness of time, but we think we're very close. We've retraced 78.6%, slightly more than that. From the standpoint of where things could go, well, we think hard down is the next big, important directional move for the market over the next several months. We think this could carry deep into the first quarter of next year before we see, intermediate wave 3 of primary wave 3 down bottom. It's a third of a third wave decline that we're looking for, which should be the most powerful, most dramatic, and probably cover the most ground in terms of real estate, from point A to point B. And so we're looking for something that could carry the S&P down into, say, the 2,700, 2,775 area at the high end, perhaps as low as 2,450 on the S&P. That seems, crazy, to a lot of people. Most people that are following the market don't think that that's a possibility. They think that the market's going to break out to new highs, before year end. I think that's wrong. I think that we'll find out soon enough, right? But I think the market's pointing down longer term.
All very scary, those numbers, every time you say them to me. So, Jeff, you have an extra slide in here this week where you're exploring some more Elliott Wave perspectives. Could you talk us through this as well? Sorry, I'll let you have a little sip there to refresh
Yeah,
your.
it's tough, all this talking. I'm a little long-winded, and I apologize for that. But, we wanted to look at the S&P 500 equal weight index. As we've been kind of talking about all year, it's the market's price action has been driven by 7 stocks, widely, known as the Magnificent Seven these days. We all know which ones they are. It's Microsoft, Apple, Google, Amazon, Tesla, Nvidia, and Meta. Those are the big names that are moving the market, that are responsible for the performance. If we looked at year-to-date performance of the S&P equal weight, it's up about 3% right now, whereas the S&P 500 itself is up 16, something like that. And so we're looking at a broader swath of stocks, and we're taking the emphasis off of the Magnificent Seven. And when we do that, and we look at the S&P's decline from the July 27th high, it is a clear impulse pattern. There's no there's no confusion. The Elliott Wave formations, the wave formations themselves, are much more clear, and in addition to that, they are much more proportional. And so we can count at every degree of trend, from minute degree to minor degree to intermediate degree. We are seeing very clear 5-wave impulse patterns pointing down, 3-wave corrective waveforms pointing up, reversed by 5-wave impulse patterns to the downside. And so, when we finally reach the October 27th low, there is a clear 5-wave decline at intermediate degree. And that's why we believe that the S&P cap weight is basically, taking a slightly different form than the equal weight, but the equal weight gives us a very clear perspective of what's going on. Also, when we look at the recovery rally off of that October 27th low, it is a clear 3-wave rally, an A, B, C zigzag. It has retraced proportionally less than 61.8% of the advance, or of that decline, the prior decline. And so, that is a typical proportional retracement, a Fibonacci 61.8% retracement. We haven't hit that yet, and we might not. But if the market does decide to push higher into, the November 27th cycle turn date, as we kind of, proposed it's possible, then maybe we do get to that full 61.8% retracement in the equal weight. But from there, 5 waves down are followed by 3 waves up, and 3 waves up are always followed by 5 waves down. And so, this pattern is repeating, and it's self-similar at every degree of trend. And so we have a high degree of confidence that the next directional move for the market will be hard down, and it will be dramatic and powerful, and it will cover a lot of ground to the downside.
Jeff, before I let you go, I just want to remind our viewers that obviously in your weekly piece, you do have your top actionable trade ideas, 5 longs, 5 shorts. So I would urge everyone to subscribe and check them out on Substack, because there's some great calls in there and some good looking ideas if you want to actually monetize any of this. So I would urge you again, check that out. So Jeff, before I do let you go, can we just talk quickly about some sectors, your sectors that you like going ahead, and maybe if you could look at them from a valuation basis as well as a relative strength basis as well.
Yeah, the sector picture is a little confusing right now. Last week, the market was carried by cyclicals. For example, credit cyclicals, the real estate segment of the market, REITs were up 4.6% last week. Meanwhile, the defensive stocks, staples, for example, were up just 0.8%, so less than 1%. So you can see even that every sector was up last week, but the worst performers were the best performers last week. So those that have done worse year to date performed best last week. When we look at what we like, we continue to want to focus on sectors of the economy that give us a really good margin of safety, the cheapest stocks that money can buy, and those with the highest cash flows and those with the best earnings revisions. And you know what that is? It happens to be energy. Energy is the only sector that saw fourth quarter earnings revisions to the upside, revenue and earnings revisions to the upside so far. And so, we think looking at valuation, energy looks very, very attractive, trading at 10, 11 times this year and next year's earnings. If we just, juxtapose that compared to technology, which happens to be the big winner of the year, well, tech is very, very rich. It's trading at 30 times this year's earnings, 26 times next year's earnings. And that assumes next year's earnings are going to come to fruition. We saw a large swath of technology stocks see downside revisions for the fourth quarter. So it's highly possible that those numbers are imaginary, and that PE valuation is much, much higher on a forward-looking basis than most people expect. That being said, if we look purely at relative strength, it's technology and communications that are leading right now. And that's because of the influence of the big mega cap tech stocks in the Magnificent Seven. Cyclicals are reversing. I'm talking about traditional cyclicals like energy, for example. It's been in a downward reversal in terms of its price action relative to the benchmark, as have industrials and materials and other credit sensitive, discretionary, for example. These have all kind of turned to the downside. That being said, we are seeing defensive sectors such as utilities and staples show some signs of stabilization and improvement. So, for the very, very near term, meaning the next, week, I think tech and communications can continue to push forward. But, we are seeing some signals, and I'll just give you one that I didn't mention in the note because note was published Sunday, and I brought this to light yesterday. But the NASDAQ 100 posted a new recovery high. Well, 50% of the market cap of the NASDAQ 100 is the Magnificent Seven. It posted a new recovery high yesterday, but its 13-week rate of change made a lower high. In fact, it made a lower high than it made in both July and June. So it's kind of a double negative divergence that's evident in the NASDAQ 100. That tells me that we're at the very, very end of this move in NASDAQ stocks. These negative divergences, more times than not, tend to mark a meaningful reversal in trend. It's an impending trend reversal in the NASDAQ 100. So, I think we're in the very we're in the final innings of this relative strength of common tech. And I would look to the defensive areas such as staples and utilities as being interesting right now as a place to rotate if in fact the market is on the precipice of a third wave decline, as we think it is. Those segments are showing stabilization. They are showing some improvement. And if in fact we get that to play out as the Elliott Wave analysis suggests, as the cycle analysis suggests, as the economic analysis suggests, then I think defensives could be the place to hide.
Defensives. Let's get on it. Jeff, as always, really appreciate your thoughts from Alpha Insights.
Always a pleasure.
And of course, make sure you check out Jeff's content on Substack. The address is hugeinsights.substack.com. Thank you for watching, and until next time, good luck investing.